But it is something that still to this day has some sort of relevance, some sort of meaning, and it's the US cash open, that first initial. Remember, we break it down into pieces. But the US Open breaks down into basically three pieces. There's the initial balance, there's the opening drive, and then there's a profit take. Yeah. So there's the initial balance, the opening drive, and then the profit take. And it normally falls into those three sections, right? So if I look at, for example, the S&P from yesterday, so that we can look at the whole phase of it coming into today's market. So we've got the cash open. So there's the cash open. The initial balance, obviously, I count as the first 15 minutes or so. Okay. So this is the initial balance area here. What happens after the initial balance is we get the first trend of the day. A lot of the times, if the initial balance trades down and then breaks above the initial balance, it's a very strong signal. Exactly what happened. They took the market down to become bullish. Because this is where the biggest volume of the morning session is, that 15 minutes, correct? So it's where the biggest manipulation is likely to be, is that first 15 minutes. Does everybody buy into that as a storyline? First 15 minutes, the biggest volume is where the biggest manipulation is going to be. So when it takes the price down to break higher, you can see that that was an exact storyline. And you can obviously see the takeaway from that was brilliant. So what happens next? Well, we normally have the next data is normally going to be at 3 o'clock. 3 o'clock London, of course. So what normally happens is that everybody banks money coming into 3 o'clock. So in other words, we go along, the market should make a high 3 o'clock-ish. Okay, because that's when we get the market reversal at 3 o'clock, right? So when I look at 3 o'clock, I look for the previous high at 3 o'clock. So there's 1448 there. So there's the previous high coming into 3 o'clock there. So that should be the market reversal from 3 o'clock onwards there, shouldn't it? Why the market reversal? Well, it's not always a market reversal, but this is the basic idea of the opening drive by the floor traders. Their trade normally lasts about an hour. Most floor traders try and be on the floor for about an hour. The first 15 minutes is frantic, trying to get position, trying to get position, trying to get position, trying to get position. The next hour is the move, the markup, the markdown phase. And then 3 o'clock coming into the next big data, if there was big data at 3 o'clock, they would use that traditionally as their profit take and their walk away. A lot of floor traders will finish 3 o'clock London time, which is going to be 10 a.m. New York, 10 a.m. New York. Yeah. So obviously that gives you an idea that this is more likely to be a sell than a buy up here. And obviously when it breaks north here, it was a very, very straightforward buy into the cash open drive, which was here. And obviously I got a very, very nice trending takeaway during that period. Very, very good trade, obviously, and a fantastic outcome. Absolutely fantastic outcome. So you can see that it is possible to find some of these kind of ingredients. If we look back at the previous day, where obviously whereas today's still forming, if we look back at that previous day where we got this enormous trade here, well, let's take a look at how that would have formed from the same approach. It's always good finding other days. So there's the cash open. And obviously we'll take it along to 1444, which is the initial balance. You can see it's a pretty big initial balance. Very difficult to get a read on this. But you can see what happened. It did break north from the initial balance here. So the feeling is that this is the low here. So obviously when the price trades down into this area, you're still thinking buy side when it reverses off that trade. And obviously you're thinking that this price will trade through to about a top edge at 3 o'clock. Now, previous to 3 o'clock, the top edge was here. There was a top edge. We've got an overnight top edge here, which obviously was pretty interesting because that's where the price did stop. But the previous high was here. So using the same logic as we did in the early example, we would imagine that this would be a sell trade. This would be where the sell reversal would form into this little balance area here. And obviously the sell reversal for the, basically I think they sometimes used to always call it the New York reversal. Has anybody heard of the New York reversal trade? In the olden days, I think that's basically what it was called, was the New York reversal. So they waited for the 3 o'clock data. They closed out positions coming into 3 o'clock data, and either 3 o'clock accelerated the move or trashed the move. It did one or other. It accelerated the move or it trashed the move. And it would trash the move because profit taking, accelerated the move because there was a confirmation of the original move. And obviously the takeaway from those trades, you can see that that resulted in a relatively easy, straightforward short sell. So it comes from that initial balance, the break above the initial balance, suggesting that it turned out it wasn't the low of the day because the price did retest this. Remember, if the market breaks north from the original initial balance, it's probably going to be a bullish day. So you'd have had to have given this a little bit of consideration here. Well, as you do for any day lower day high, isn't it? Any day lower day high. And obviously when it hits into the day lower the day high, at least you're recognizing that that's the case. Let's go back one more day again, guys, because again, it's dead easy to think that you're cherry picking some examples and you don't take account of some of the other examples. But again, we get a very volatile open in this day here. And again, we can take it along to 1444. And again, we can look at 1444 as the initial balance. Now, when it breaks the high here, you're automatically thinking buy side trade. Comes off like an absolute true train. You're thinking to yourself, fair enough. And you're obviously going to be considering the fact there's probably a little buy opportunity against a spring here. But again, that gets trashed and we end up below the bottom edge, telling you, well, wait a second, this could well be now bearish. Now, you'll see by that point there, almost entirely the initial balance is now contained inside that entire first move. So in other words, there was no trending phase. It hadn't ever happened. There was no trending phase. It never developed. So there's no reversal trade either. If you haven't had an initial trend, if you haven't had an initial markup or markdown, you can't reverse anything. There is no reversal trade. So this is basically just a pivot. It becomes a pivot price in here, doesn't it? And obviously you're going to just trade this and say, well, there's no trend, so what am I supposed to do? Well, as it turns out, obviously the trend is now developing on the sell side. You're going to sell it. Simple as. Remember, it's buy side above, sell side below narrative. And obviously the sell did develop into a beautiful, beautiful sell. So these are things that you start spotting, isn't it? These are the kind of things you start recognizing. So into the cash open today, you can see the initial cash open. There's the high of the cash open there. There's the current low of the cash open here. We're moving into the initial balance. That's it right there. So there's the initial balance. And obviously now you're starting to watch to see what they're doing. Now it seems as if they've taken it down to buy it at the moment. So it looks bullish at this point, because the idea is that you're looking for where the bids and the offers are. But you could also argue that there was plenty of willing offers coming in as well from this point here. So there's bids here, there's offers here. So we can use that as our balance area, can't we? If there's offers here and there's bids here, then obviously if we can build a structure above this level or below this level, it's probably going to tell us where the markdown or markup is going to come from, yeah? So if we've got bids here and we've got offers here, one of those two is going to have to give up. The market's not going to stay in this area for the rest of the day. So the market's going to give up this area with the first initial drive. So we start looking for that first initial drive. So a break above here, a failed auction sell, tells us that the offers have now gone. So they'll break it above, sell it, no offers, then they'll mark it up, or they'll break it down. No bids, they'll take it up, no bids, they'll take it back down and they'll mark it down. So the basic idea here now is that this is what they're going to be doing. They're going to try and test this, see if there's any offers coming. If there's not a strong offer, the market's gone. And that's exactly what you would imagine they're going to try and do. Or they'll do the exact opposite. They'll take it down. They'll see how many bids come in into the bottom edges. No bids, very weak. Okay, probably going to take it down away from those ledges. They're going to take it down along from those ledges. So you can get a basic feeling about how they're testing the water in these. They don't know if there's bids or offers. They don't know if a big seller is going to come out or come into these markets. They don't know anything yet at this stage. They can see some of the order flow, of course, but they don't know whether this is going to bring in a lot of bids or whether this is bringing in a lot of offers. They don't know that yet. They just know that the market's got some sellers, the market's got some buyers. They're manipulating the price to see if those sellers and buyers keep coming. And obviously, if they can get a read on this, then the market maker will try and recognize there's no offers. They'll bring it down because there's no offers. They're trying to get long inventory for the bid up. So if there's no offers up here, the market maker will try and bring it down back into balance, get long inventory as much as possible, and then let the market mark up. So we look for the cash open to explode and for the trend to develop into about 3 o'clock. If it still hasn't developed into 3 o'clock, it's going to be the same as that last day we looked at. And that last day, of course, you're looking at a market that simply hasn't got anywhere to go. In other words, a low volatility day. So we already know today is a low energy positive gamma day, don't we? We knew that from last night's tweet. It's a low energy positive gamma type day. So we'd actually expect this type of thing to happen. We'd expect the price to do exactly what it's done at the cash open. We wouldn't be surprised by that outcome. So why are you surprised by the outcome if you are, right? Kind of makes a lot of sense now, doesn't it? That gold sell, guys, down to 82s, not bad from 88s. So that's a $600 winner for anybody that took the gold short trade that we shouted earlier. $600, guys. Live trade call from that gold short play. Yep, you heard that right.